newsmakers, and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, bets are growing that the U.S. rate cuts could come sooner than expected. That's after a report that President Trump is considering an early appointment for the next Fed chair. Now, Trump says he has a short list of candidates in mind to replace Jay Powell. The president has been pressuring Powell to lower rates by 2.5 points and took another jab at him while speaking at the NATO summit.
Yeah, I know within 3 or 4 people who I'm going to pick. I mean, he goes out pretty soon, fortunately, because I think he's terrible. We have no inflation. We have a tremendous economy.
Now, we're joined by Beata Manthi, European Equity Strategy Head at Citi, and our Justina Lee. So thank you both for joining us. I don't think it's 2.5 points, so we'll get to that in a second. But, I mean, the overall sentiment is actually, even if Jay Powell doesn't get replaced, President Trump could appoint someone that would step in next. And so you have like a shadow Fed chair that, you know, that would confuse the markets, Justina.
Yeah, exactly. And it really stole the thunder from Jay Powell's testimony here, which kind of tried to send the opposite message to markets. And what's really interesting about this Wall Street Journal report is that they're saying, you know, Trump could name a candidate potentially by September or October. And even though the next chair wouldn't come in until May, you effectively kind of have this like backseat driver. And I think what the market reaction is telling us, you know, with the dollar depreciating, yields falling, is that even though a lot of these names being floated, you know, Catherine Hassett, Kevin Marsh, are kind of like known quantities to the market, people are expecting someone who would be quite aligned with President Trump in terms of the trajectory of interest rates here.
But I mean, the read across of that is again kind of like a confusion, right? Even if Jay Powell doesn't get changed before his term ends, it doesn't spell any clarity for financial markets.
Absolutely, but if the signal is a dovish signal for the Fed, overall, equity markets would like it, right? What you have to think about, what it's going to do to the rates differential, what it's going to do to the FX, so probably a bit more of the euro strength versus the dollar. This is our base case. And perhaps further down the line, it would help different parts of the market to search further versus what has been driven in the US, i.e. tech, mega cap tech. Perhaps, you know, mid caps will start looking a bit better because they are the most rate sensitive part of the US equity market.
But I mean, it's difficult. I mean, we kind of, you know, the market, I guess, is looking at a possible policy shift from the Fed. That's not what I heard from Jay Powell. I mean, I was listening to the testimony. There hasn't really been a hint from them at all. So is there a worry that, again, there are like dislocations?
It is a possibility. Our view, the view from our U.S. economists, is a bit ahead of the consensus, ahead of the market pricing, that indeed the Fed will start delivering more cuts than the market is pricing in already this year.
Justina, what else are we looking at? There's, you know, again, a lot of oil. We look at stockpiles in the U.S. and what Donald Trump does of course, with Iran.
Yeah, exactly. I mean, it's kind of interesting that the market seems to have moved on from those geopolitical tensions really quickly. I think kind of, you know, obviously the next dates we're looking at, you know, all coming in early July. First of all, what's going to happen to those tariffs, given that it feels like markets have kind of assumed that we're not going to get a hike back to those highest rates that Trump originally announced on Liberation Day. Another focus is, of course, what's going to happen to the one big, beautiful spending bill in Congress. I mean, that's supposed to move pretty quickly, given that Trump also gave himself a pretty tight deadline here. He wants it done by July 4th.
Beata, I mean, the other big story, of course, was from NATO and the defense spending. How much will it give a boost to certain industries in Europe?
We are getting an increasingly positive story from that side, right? So we are talking about 5%. I have to tell you, Francine, that back in February when we had big announcements, nobody believed in 3%. Right? Now 3% is a non-brainer. Even 3.5% is probably a non-brainer. The market and market participants are doubting that the 5% is going to happen. Now 3%, according to our calculations, would translate into up to 3% cumulatively extra GDP for the Eurozone over the next 4 to 5 years. So it is something. And that could add 2 percentage points of extra EPS per annum over the next 5 years. And that's only defense, and that's from 3%. So whatever the number is going to be, it's going to be more now, right?
And Beata, overall, I mean, you have this, great insight that is called Navigating Uncertainty. It's basically the mid-year roundup of 2025. Like, what have we actually learned in the last 6 months that you want to incorporate differently in your portfolio from now until December?
So there are short-term risks and long-term boosts for Europe, right? Short-term risks. Okay, from geopolitical conflict perspective, we have a bit of calm. That's great. But let's not forget that we are getting into this July 9th deadline on tariffs. Tariffs have not gone away, and the bill needs some funding from the tariffs. So this is our worry, right? And what we find, we have this geopolitical or geoeconomic, should I say, risk premium model that tries to capture how much of these risks is priced into the market. There were very high risks around the Liberation Day. Right now, after the market rallied, the market is pricing in historically average level of risks. It doesn't mean it's a sell signal, but it means that any acceleration in either policy uncertainty, tariffs, or geopolitical conflicts, higher oil prices, risks, could cause some level of volatility in the markets. That's my short-term worry, right? Yeah. Long-term, it's the stimulus, it's unlocking growth on Europe, could provide more boost to the valuations and cause actually long-term re-rating.
I also want to talk to you a little bit about M&A or M&A possibility, but let's focus on one corporate story. Shell says it has no intention of making an offer for BP, having denied a report that it was in talks with its London-listed rival. Now, for more on this, we're joined by Will Kennedy, our senior executive editor for energy and commodities. Well, I mean, this is something that's been going on for a while. There's been speculation. Bloomberg wrote something on it back in May because BP is so weak. Shell now denying these allegations.
That's correct. Obviously, BP has been a big story in the oil industry over the recent months. As you say, Francine, it's underperformed its peers. Its strategy's been in question. The CEO isn't getting the best notices. So it's inevitable that you do get that M&A speculation. And of course, Shell is in the frame as the most likely and in some ways probably the only really viable buyer, creating an enormous UK oil company. As you say, we wrote a couple of months back that they had been running the numbers. The Journal took that forward, saying that there had been some preliminary talks. Now, Shell has denied that very strongly. And what's important about that is that rules Shell out from making a bid under UK takeover code for the next 6 months in most circumstances. So in that sense, it does move the story forward. And I think it will probably refocus attention a little bit away from the M&A story and towards how effective the CEO, Mario Olkinkloss's strategy is. And what Elliott, the active interest investor that currently owns 5% of BP, is going to do to really drive strategy forward and try and raise returns.
So, well, what happens, I mean, the UK has, conduct authority basically says that because they said they won't go after it, now they can't do anything for 6 months. Is that right? That's
correct. Once you said we're not going to make a bid, you are bound by that for the next 6 months. There are two exceptions. One, if someone else comes in and makes a bid for BP, and then your hands are untied. And secondly, if BP approaches Shell and said, we'd like to talk about you buying us, they can reopen the discussions, but they cannot themselves make an approach to the BP board for at least 6 months.
Well, thank you so much, Will Kennedy, there, our senior executive editor for energy and commodities. We're back with Beata Manthi and Justina Lee. Beata, I mean, without specifically talking about Shell and BP, are you expecting in this kind of environment just bigger M&A, more M&A?
So M&A activity has been subdued for quite a few years now because of uncertainty and because of the higher rates, right? So we have done a big report with the analysts on uses of cash, asking them where the companies are going to spend their cash flow generation. And the biggest uptrend into the next year, not yet this year, next year, when rates go down and perhaps we have some more uncertainty, is a pickup in M&A. And the sector that has been mentioned the most across all the European sectors is the financials.
Okay, so that's something that we definitely need to watch out for. I mean, M&A, again, we see a lot of reports, Justine, of M&A saying, look, if you're concerned about tariffs because they're on, they're off, and a lot of chief executives may just sit on their hands in general, not only for M&A, but also CapEx.
Yeah, exactly. I think it's been kind of pretty disappointing because I'm sure when Trump was elected, a lot of people thought it would be the exact opposite. And what's been interesting is we've seen a lot of reports of these big deals, right? Not just Shell, BP, but also in the U.S., Northern Trust and BNY Mellon. And we've kind of heard some news lately that maybe, you know, the U.S. is going to rescind this Biden-era rule that's going to kind of put more scrutiny into bank mergers. So are we going to kind of see more action there? And I think everyone's kind of waiting for a bit more certainty to set in.
Okay, thank you both for joining us. Beth Amanthi, head of European Equity Strategy at Citi, and our very own Justina Lee. Coming up, we check in on the top lines from the NATO meeting and look ahead to today's EU summit. We'll also be speaking to Carl Bildt, co-chair of the European Council for Foreign Relations and former Prime Minister of Sweden. That's next, and this is Bloomberg. Welcome back, everyone. Now, EU leaders are meeting in Brussels for a crucial summit. On the agenda, Ukraine, the Middle East, and defense. The meeting comes right after NATO leaders agreed to increase defense spending to 5% of GDP in a win for U.S. President Donald Trump. However, one nation came under fire from him for holding out.
You know, Spain is the only country that... Are you from Spain? Yeah. Good, congratulations. You're the only country that is not paying. I don't know what the problem is. I think it's too bad. So we'll make it up. You know what we're going to do? We're negotiating with Spain on a trade deal. We're going to make them pay twice as much. And I'm actually serious about that.
Let's go straight to Bloomberg's Oliver Crook. Ollie, break down the details from the NATO talks.
Yeah, Francine, Spain coming under a little bit of heat, but I think overall this is one of these sort of rare interactions between EU leaders and Donald Trump where everybody can kind of say that they walked away with a win. For the European leaders, they managed to keep Trump in NATO, managed to get him to continue to honor Article 5 and really sort of speak very positively about it. And Trump, on the other hand, delivered on an election promise that he had made, which was to get the rest of the NATO alliance to pay 5% of GDP to go to defense because he feels that the United States has been subsidizing European welfare states by basically outsourcing all of their military spending to the United States. I spoke to the president of Finland just moments after this agreement was ratified yesterday. Have a listen to what Alexander Stubb had to say.
The outcome, I think, was a great success for the whole alliance. So basically what happens is that you set a target, and after that you review those targets through capabilities every year. Technical terms, it's called NDPP. So every member state has to fulfill the targets that have been set, and I'm quite convinced that the alliance, SECURE, and the military staff in general will make sure that the member states do their part.
And it's in the interest of a lot of leaders to call this a really historic step. But I think thinking in the context of what this will mean for European economies going forward, I think it's fair to say that it will be. I mean, as you know, Francine, Alexander Stubb had retired from politics. He told me also later in that conversation that if you had told him 3 years ago that he would be president again, that Finland would be part of NATO, and that they'd be spending 5% of their GDP on defense, that you should go see a doctor. But that is the reality that we're facing now today for NATO and the different allies. What becomes the difficulty now, Francine, is the conversation of how you pay for it all. And that's why sort of Spain came under fire. Spain says you can meet all of your defense capabilities without spending 5% of GDP. And that is going to be some of the conversation before leaders today as they descend now after NATO here in Brussels for the EU leaders meeting.
Ollie, the action, of course, now moves to EU leaders in Brussels, where you are.
Yeah, that's right, Francine. So listen, there's going to be conversations about a great many things, about defense, about sanction packages on Russia, on Ukraine, potentially longer term, now that you've committed to 5% of GDP, how you're going to pay for it, potentially Eurobonds. But I think the focus for many of the leaders today is going to be getting a sort of collective approach to how to deal with the trade war. Because remember, Francine, that deadline of July the 9th, where 50% tariffs go up between the United States and the EU, is only about 2 weeks away. And from what we understand, the negotiations between the EU and the United States are not going terribly well. We've heard from certain policymakers within Europe that basically the United States has a lot of imbalanced requests, that they're basically unilateral demands of the EU. I just spoke to Teresa Ribera a couple hours ago. She is the antitrust commissioner here in Europe, saying that basically all of the things that the United States wants to push on regulations on U.S. tech firms, they want to tie that as part of the trade deal, are basically off the table. We just heard from Friedrich Merz, who just walked in. This is his first European Council meeting. He says that the priority needs to be getting a deal fast with the United States. So they're going to have to get a collective approach here. Do they retaliate if the United States moves forward with, say, 10% baseline sanctions? Those are questions that we have not yet answered at the EU leader level, and that'll be one of the prominent conversations here in Brussels.
Gosh, first European Council meeting for Friedrich Merz. I'm excited for him. Usually they last a long time. Let's hope this is, not the first that goes also through the night. To our Oliver Crook there, our Europe correspondent with the very latest from Brussels. Now, for more on all of this, we're joined by Carl Bildt. He's co-chair of the European Council for Foreign Relations and former Swedish Prime Minister. Carl Bildt, thank you so much for joining us. It's so great to actually see you this week. When you look at what happened in the last 2 days, it was very clear that the fact that NATO members suddenly agreed to raise defense spending to 5% of GDP was a big deal. How will this change Europe going forward?
First, it wasn't really 5%. We have a definition of defense spending that's been there for years, and by those, and that's according to that we've discussed in the 2% target, and it is a commitment to raise defense spending to 3.5%. That is very, very substantial. Then it was added this 1.5 in order to please President Trump. And exactly what's going to go into that remains to be seen. There's going to be a big accounting exercise that's going to have some entertainment aspects to it, I fear. But 3.5 is a very substantial increase in defense spending. We've seen defense spending going up in the European countries by roughly a third in the last few years. There will be a need to expand by at least another third in the next few years. So that is substantial, that particular result, although not 5%.
Yes, and you're right. I mean, look, for some key European allies, these ambitious pledges, at least in theory, will go up against fiscal and political realities as well. But first of all, is this, Europe coming together to at least try and defend themselves? Is this going to be a more autonomous Europe? Is that the underlying will from European leaders, or are they just pandering to Donald Trump?
Well, there's an element of all of that. But it's going to be, if we look forward, it's going to be a NATO with less of America. There's no question about that. I think we're going to see later during the year a reduction in American military presence. They're doing a so-called force posture review. They do that regularly, but I mean, they have indicated that forces will be reduced in Europe. And add to that the threat picture, the Europeans will have to do more. So there will be a stronger NATO, but a stronger NATO with less America, if we look ahead. And that's sort of a reflection of the global political realities. The Americans are having their focus primarily elsewhere. The Trump administration doesn't see the Russia threat in the same way as we Europeans do, for reasons that are somewhat obscure to me, but that's a reality. So that's where we are heading. And this particular NATO summit could be seen as a step in that direction. The EU summit which has been started as we speak, is another step in that direction.
How do you see it? Is there, there's a growing anxiety over the reliability of the U.S. as a military ally. Will that allyship also finish maybe sooner than we think?
Well, we simply don't know. I mean, the thing with the Trump administration is, of course, it is fairly unpredictable, to put it in mild terms. We haven't a clue, as was indicated just, what's going to be the nature of the trade relationship across the Atlantic in just a couple of weeks. We've never been in such a situation of unpredictability and volatility on key aspects of the transatlantic relationship as we have now. And that means that there will be the need for the Europeans to, yes, hope that the Americans will be with us, hope that we have a good relationship with them, but also preparing for other possibilities. A NATO with less America, absolutely. And Europe reaching out to the rest of the world on trade issues more than perhaps would have been the case before Trump arrived on the scene.
What is the right way for Europe to navigate actually the U.S. right now, even if we see what happened in Iran over the last 10 days. There's certainly intelligence from the Pentagon that seems to contradict President Trump. What's the right way for European leaders to deal with this contradiction?
Well, there are a lot of contradictions. I think Europe must demonstrate that it can do its own thing. Europe needs to concentrate on doing its own things. That is the competitiveness of the European economies. That's going to be talked about between the European leaders during the day and tomorrow. That's going to be the trading relationship with the rest of the world. I think the India relationship, if that can be fixed, if that can be augmented, would be very important. We have the Mercosur, we had a summit with Canada the other day. So reaching out to the rest of the world in this age of Trump volatility is important. China, there's a summit coming up with China at the end of July, which is going to be important to sort of see how that relationship can be balanced. And then, of course, see how one can accommodate these increased defense spending needs with the obvious fiscal realities that are there. There are a couple of countries that have sort of deficits that are too high and debts that are too high. And at the same time, defense spending needs to get up. Not an easy equation.
We had a story yesterday saying the European Union, of course, wants China to resolve the export issue on rare earths around these rare earth magnets before a meeting with their leaders next month. What is the right way for Europe to approach China right now?
I think the rare earth restrictions that or export controls, to be precise, that China put in place were a reflection of what the Americans did on high tech. I mean, the Americans had on high tech that we have export restrictions and they are dual use, and accordingly we deny them to certain parts of China. And the Chinese are saying exactly the same thing, that the rare earths are dual use, so we have export control and we deny them. So Europe shouldn't get into that particular fight. And I think we should seek some sort of accommodation with the Chinese so that we are sort of outside of that particular part of the battle in order to have the more or less secure supply of rare earth minerals. Then long term, of course, we need to have a situation where we have less reliance on just one sole supplier. But that's going to be one of the issues. Then there's going to be a number of other issues. I mean, the Chinese are less happy with the tariffs on EVs, and there are European concerns on overcapacity. But it's a fairly full agenda. But hopefully the possibility of sorting that out in a constructive spirit.
Mr. Bildt, I mean, overall, what's the biggest danger for Europe right now? I know we've talked about, crises, about things that Europe needs to deal with. I don't know whether you were uneasy when the NATO Secretary General showed a lot of flattery towards President Trump, or that's the right way to be negotiating or dealing with the U.S. right now?
I think he perhaps overdid it. Perhaps not even slightly, but overdid it significantly. But I mean, flattery does seem to work with President Trump, but there should be a limit even to that. The greatest danger, I mean, no question about that, is the Russian aggression in Ukraine. President Putin should have, I don't know how much confidence he has in the ability of the Russian army to deliver what he wants in terms of win. I don't think the Russian army can do it. So he is counting on the weakening of the will of the West, the weakening of the Trump engagement for a ceasefire. It's already have that weakening. He's counting on the Europeans not being willing and able to step up when it comes to replacing some of the American support to Ukraine. That's going to be absolutely critical.
Yeah.
Because the future security of Europe. Yeah.
Thank you so much. Future security of Europe, Carl Bildt, their co-chair of the European Council for Foreign Relations and former Swedish Prime Minister. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Markets bet on lower U.S. interest rates after a report that President Trump could be months away from naming his choice for the next chair of the Federal Reserve. Oil giant Shell says it has no intention of making a takeover offer for rival BP, closing down speculation after an earlier report. Plus, EU leaders gather in Brussels to discuss Russia sanctions, tariffs, and the Middle East, a day after NATO's agreement to spend 5% of GDP on defense. Now, onto a corporate, and Grindr, the LGBTQ dating app, has laid out an AI-driven roadmap to fuel growth with plans for several new features this year. Now, the company has recently been growing its headcount to support the developments. Now, analysts at Bloomberg Intelligence forecast continued growth and even expect the company to meet guidance for a revenue increase this year of 26%. Well, I'm delighted to be joined by the Grindr's chief executive, George Arison. George, thank you so much for joining us. I mean, your business model is actually, pretty incredible because you've done so well when some of your rivals have not. What do you think is the secret of your success?
Yeah, so first, thanks for having me. Second, it's great to be in London and a great time to follow the last episode you did because the Secretary General called President Trump daddy. It's a very popular tag on Grindr for users to describe themselves as daddies or wanting daddies, so I think it's very serendipitous.
Unrelated to geopolitics.
Yeah, totally.
or maybe not. We don't know. We'll keep it open.
So Grindr has about 15 million users, monthly active users worldwide, who use us in a very frequent way, and average usage time is about an hour a day. So Grindr is a really big part of people's lives. In many parts of the world, it's the only way that gay and bi people can connect to each other because we operate both in countries like the UK and the US, but also in places like Egypt, where it's very hard to be gay. And we mainly serve as a way, started out being a company that enabled people to find a casual date. And over time, users started using it in many other ways. So today, people use us to find long-term relationships. In the US, about 35% of current long-term gay relationships were started on Grindr, which is a pretty remarkable thing. Also for friendships, for networking. And our strategy is to be the gayborhood on your phone, where if you go to Soho, you have a lot of experiences that you can enjoy beyond meeting guys, in London that is. And we want people to have that opportunity inside the app if they're not living in big cities, a lot of people don't.
And George, this is why you also started something called gayborhoods, right? In countries especially where LGBTQ plus is illegal. So tell us a little bit about that, and again, how that feeds into your bottom line and revenue.
Yeah, I mean, our goal is to not necessarily go after other segments of the population. We want to focus on the user base that we know really well, which is gay and bi men, but do more things for them. And we know that our users spend a lot of money on other products elsewhere, but we think that we can serve them better. So, for example, in the US, in the last few months, we launched a product called Woodwork, which is a telehealth product where you can buy ED medications designed for a gay user directly from us. Now, that's in massive beta. It's very early stage, but that's an example of the kind of products we want to offer over time as we expand our brand to more things that gay men need.
And this is basically to grow the business. So is it like an ecosystem or infrastructure to help people and a certain type of community, and especially countries where it's illegal or difficult?
Even in places like where it's totally legal and you have a very good life, if you live in a small rural area, there are not that many gay people around you. And so your ability to have critical density is very difficult. Like, that's not the case in London, not the case in New York, but even in mid-sized cities, you don't have that many people. And so Grindr is a way for people to connect. That's what a gayborhood is. But we do that on a mobile device at a global scale.
George, would you ever move from a subscription to more advertisement-based business model?
Yeah, we have an ad business. It's about 15% of our revenue, and it's done extremely well over the last few years as we started to invest in it, because we had not been investing in it for a while. And obviously, we would want that business to continue growing. What we've said publicly is we wanted to keep up at the same pace as percentage of total revenue as it has been in the past, which is roughly 15 to 16%. Given that it's smaller, it has to actually grow faster than the rest of the business to kind of keep up with that. And we think that kind of works. A big thing is, advertisers are still very, very nervous about working with companies like us, which is really unfortunate in today's day and age. Well, after what happened with Anheuser-Busch, a year and a half or 2 years ago, I think there's still a lot of hesitation around touching anything that in any way kind of suggestive of that space. And I appreciate the risk, but I also think it's totally not warranted. And so a big thing for us is getting more advertisers to work directly with Grindr, because we have an audience that people actually should want, right? High disposable income, wealthier audience, more educated, and they usually don't have children, so they spend money on experiences, and advertisers should want that.
And so has that gotten harder actually since Trump has gotten in charge and there's been a rollback or a pushback against a lot of D&I initiatives? Is it harder to find the advertisers?
We haven't seen that big of a difference post-Trump. Actually, I think it's just been hard for a very long time. When I took this job, my husband is like, "You're going to experience homophobia in the ways you've never experienced before." because he had lived in places where it's a lot more homophobia. I had been in places where it's very tolerant, and so hadn't lived through that. And the reality is that that's what kind of we feel is like a lot of businesses that want to be very supportive have these other considerations that make them very stressed out about that. But I don't think it's a necessarily post-Trump thing. It's just been the case for a long time.
When do you see that changing? Do you see that changing?
Well,
something?
Part of our mission is to be a very successful business, and through our success, drive the world to be a better place for our users. And so I think we actually can do a lot by being as successful as we are and continue to drive for that by then getting people to actually change their opinions, right? The same way that individuals who were gay, who were successful in 1990s and 80s in their own careers, helped change people's perceptions of gay people and were really critical to gay rights becoming accepted. We think as a business we can kind of have a similar impact on the world.
George, talk to me a little bit about AI, because this could change everything actually in terms of dating apps. So someone who's on your app would have, I guess, an AI agent, maybe doing a little bit of the choosing for you.
Totally. So when I had built an AI company prior to Grindr, so I was pretty connected to AI when I joined. And one of the exciting things about this was just how much data Grindr has. For example, our users sent 130 billion chat messages last year. That's more chat messages per day than people send on WhatsApp. And so we have a lot of content about people, and we can use that content, obviously only with their permission, to understand them better. And then match them with other people in a better way. And that's a huge opportunity, and that's what we're doing. And kind of the Wingman is the embodiment of that, where we want that to be very easily accessible to everybody through a chat. We recently launched a product called A-List, which I'm super excited about because it takes all these messages in your inbox, and people have like hundreds of messages in their inbox over time, and understands those messages and then creates a short list of people that we think are your best connections. And you are able to sort through them. You get summaries of what the conversations were about, any of the media that was shared between the two people, and then you can re-engage those folks, because oftentimes people have conversations they kind of forgot about in their inbox that we then bring back. So that's an example of the kind of features the Wingman will offer over time, because one of the most asked feature inside Wingman today is show me more people like this. Right. But most likely you actually already have people like this in your chats. You just forgot about them. And we want to bring those back.
And so this is all AI that you're developing in-house.
Yes.
Is that going to make the difference between dating apps that work and the ones that don't?
Yeah, I mean, I think in general for incumbents, let's say, that have a lot of data, they have a huge advantage with AI because right now AI is really good with really good data, and incumbents have the data. Obviously, again, you need to have permission from users to use it. We actively went out and sought that permission, and we had a very high take rate on that. Unfortunately, I think most companies are not appreciating that, and they don't understand that this platform shift is actually very incumbent friendly and don't want to do the investments in AI. So my view was we actually need to invest in it very aggressively from the start and make it a huge benefit to Grindr, and so we're basically aiming to be an AI native company. We've had a chance to rebuild the team dramatically since I've been there. About 85% of people joined since I joined Grindr, and a lot of them are very AI forward people on purpose, because that's what we want to be doing.
So it won't necessarily lead to job losses?
I don't think so, because Grindr is growing dramatically, right? And so we would have needed a lot more people. We're a very nimble company, 154 employees, I believe, right now, in total for, on track to do over $400 million in revenue for the year. And so I think we'll need more people regardless as we scale. But I think each person is going to be way more efficient than they ever were before.
George, how do you address safety? Because I know there's still safety concerns.
Absolutely. Safety and privacy are really critical on Grindr. Our users probably have a lot more privacy needs than most, given just how gay people are treated around the world. And so we are very privacy forward. We don't require you to have a profile picture, for example, to have a profile, because a lot of people can't have a profile picture or for many reasons. I mean, in some countries they could be killed if they had a profile picture. And so we're very privacy forward. We work really hard to protect the data. And then we have a lot of algorithmic work happening inside the app, as well as human as kind of looking over that to ensure that bad actors are not in the app, to ensure that bad behaviors are protected, because we do want this to be a community. And frankly, our users want that, and our users really support it. Like, self-reporting of bad behavior on Grindr is way higher than most comparable products, because people really care about the community and want it to be protected and treated well.
So interesting. George, thank you so much for joining us today. That was the Grindr Chief Executive, George Arison. Now, to some other stories making news, and China's Xiaomi is unveiling its first electric SUV today. Now, the YU7 is billed as a direct competitor to Tesla's Model Y, with entry-level models expected expected to be cheaper. Xiaomi's shares have surged more than 60% this year, with the company now worth more than BYD, the leader in Chinese EVs. And Mars's $36 billion bid for Pringle chips maker Kellanova faces a potential setback. That's after the EU opened a probe over concerns that the largest packaged food deal in almost a decade could thwart competition. Well, watchdogs will examine how Mars might increase its bargaining power. In talks with retailers, regulators set an initial deadline of October 31st to decide whether to approve the deal. And the chief executive of Worldline has blamed an orchestrated media campaign for the firm's precipitous share decline in an effort to dig the company out of its current crisis. Now, in a call with analysts, he said the French payment processor had been attacked by the media. A series of articles had accused Worldline of covering up fraud by some customers, which he denies. And finally, Nvidia has reclaimed its spot as the world's largest stock, overtaking Microsoft on bullish comments from the chief executive Jensen Huang at a shareholder meeting. Our Charlie Wells is here with an update. Hi, Charlie. So how sustainable is Nvidia's market rally?
Francine, that's a great question. And the theme today really is about competition. You are seeing Microsoft and Nvidia really neck and neck, but Nvidia reclaiming that top spot as far as market cap. Now, if you want to think about that sustainability issue, this is a question that a lot of investors have. How much momentum does this AI story have? If you take a look at the analyst recommendations for that stock, you can get a sense here. And this is on the back, not just of those positive comments from Wang, but also a sense that we're getting that there really are legs here to this AI play. You are seeing a significant amount of spend coming from some of the largest tech companies as we've digested their earnings over the past week, from Microsoft, from Meta, from Apple, and from Amazon. You really are seeing that AI spend helping to boost Nvidia and helping to give it that top spot as far as market cap.
Charlie, Micron also reporting results. What's the market reaction?
So here again, I'm talking about competition, but in this case, it is a company that in some ways is competing against itself. Micron really has been the darling chip maker of Wall Street over the course of this year. If you look at that Philadelphia Semiconductor Index, they are the top performer, up 51%. But those high expectations really sort of hurt them in the market yesterday. They delivered an earnings report that really beat almost across the board, but analysts and investors really wanted to see more on this issue of high bandwidth memory. That is an issue that is so important for AI. If you look at some of the commentary that we got from their CEO, he was asked significantly over and over again in that earnings call about that high bandwidth memory, and analysts and investors just did not like what they heard as far as the growth potential for that issue.
And finally, Charlie, Nike earnings also coming up later today. What are analysts looking out for?
Nike really trying to develop more of, a competitive edge here against Adidas. Over the past few years, they've really struggled there against one of their competitors. And one of the issues that investors are really going to be looking out for today is how Nike can launch and kind of, refresh some of their products. That is an issue that they've really been struggling with, the issue of innovation. And we're starting to get an answer to that. We are seeing a product that Nike has announced that they will be launching. It's coming out. It's really gaining a lot of traction on social media in sort of an unexpected way. It is called the Snowfer, and it is kind of a sneaker loafer gaining a lot of traction with followers on social media. Some on the retail market willing to pay as much as $500 for this item. I don't know that I'd be the first person to do this, but I don't really set trends in footwear.
I mean, I kind of could get behind it. The question is, do you put a sock or do you not put a sock, Charlie? It feels like it's already like an inbuilt sock, right?
It feels like that. It feels like that's the way to make this fashionable, Francine, which you do very well.
Well, I'm not sure about that, but Charlie could see you a very nice crisp suit and then the new Snowfers. Charlie Wells there with the very latest on a little bit of fashion wear, but also a lot of tech. Coming up, what does Trump's criticism of ESG mean for the future of sustainable investing? We'll discuss that next with Tukamuna from JP Morgan. That's next, and this is Bloomberg. Welcome back, everyone. Now, shares of companies linked to New York City real estate fell after Zoran Mamdani's shock win against Andrew Cuomo in the first round of voting in the Democratic primary for mayor of New York. Now, Mamdani has promised a rent freeze in the city, as well as free childcare and cheaper groceries in government-owned shops, much of it financed by tax rises on the rich. Well, the former New York City Mayor Michael Bloomberg, the majority owner of the parent company of Bloomberg News, endorsed and contributed to the Cuomo campaign. Now, for a roundup of what this means going forward for New York, but also the two parties in the U.S., let's bring in Stephanie Baker, our senior writer. Stephanie, I've been wanting to speak to you, all week, actually, since this win to try and figure out what it means. I mean, suddenly are we going to see, first of all, does this translate nationwide, or is it really solely New York? And could we see an AOC president candidate for the Democrats?
I think it does resonate nationally for sure. I think it exposes the central fault line running through the Democratic Party right now between the old guard of moderate Democrats backed by big money using traditional legacy media and the new wave of younger progressive Democrats that are exploiting new media, social media, Instagram, YouTube, podcasts, and are proposing really a more progressive left-wing agenda. Mamdani is an incredibly charismatic figure, and he was able to beat the scion of New York State's leading political dynasty, the Cuomo family. And I do think it will, give wind in the sails of the younger Democrats who are trying to upseat and revive the Democratic Party, arguing that they have been asleep at the wheel and that they really need to embrace a new, energetic, new agenda.
And Stephanie, of course, there's the EU Leader Summit. I mean, are we going to see tougher sanctions on Russia?
They're expected to approve this new package of sanctions, but of course, Hungary and Slovakia are saying that they are going to hold up the sanctions because they are opposed to this EU plan to phase out the import of Russian fossil fuels by 2027. Hungary and Slovakia are very dependent on Russian energy still. And they have vowed to veto this package of sanctions because of that phase out. Now, the phase out, they're not really able to veto the phase out, but they can veto this renewal of this 18th package of sanctions. And I think that's what they're going to try to do, saying we want guarantees. We're going to be financially compensated for any fallout from that phase out in 2027.
Stephanie, thank you so much. Stephanie Baker, our senior writer, and of course we'll be watching the EU Leader Summit very closely. Now, the Trump administration has been quick to criticize the ESG investing and withdraw from climate commitments. Nevertheless, European pension funds continue to enforce ESG mandates. Well, joining us now to discuss the future of the green economy is Truco Muna, Global Head of Sustainable Solutions and EMEA Head of Green Economy Investment Banking at JP Morgan. And he's here also for our Global Sustainability Business Forum. So thank you, Truco, for joining us. Now, first of all, look, President Trump has made it pretty clear that he's no fan of the green transition. Does it really set the U.S. back relative to China and Europe?
Well, I mean, if you look at energy transition investment in 2024, 39% of it was in mainland China, around 22% across UK and Europe, and then, of course, the US behind that, 16.2% or thereabouts. So in that sense, not continuing to help boost the sector may potentially set the US a bit further back. But when you look at the sustainable finance landscape more generally, there is this question, does the way the US go, is that the way for the rest of the world? And that is not necessarily the case because the US didn't dominate in this space in the first instance. And if you look at public sustainable AUM, it's at about $3.2 trillion right now, which is, higher than any point in that kind of sustainable finance boost we saw immediately after COVID. And around 85% of that AUM is here in Europe. And so and that, to be honest, has been, Europe has dominated. So that's been the case for a while. So what happens in the US does not necessarily determine the way of the world. But in some senses, this debate's moved on.
But it's also, could you see private capital actually in the U.S. that is going to the green transition without outwardly saying that it's going to the green transition or ESG causes?
Well, on the private capital space, we've seen around $32 billion worth of fund launches this year. EQT did a big infrastructure-orientated fund launch, $23 billion. But also Blackstone as well, with its $3.2 trillion and $3.2 billion fund in the green infra space as well. So there's plenty of activity there, mainly revolving around electrified transport, renewables and low carbon energy solutions. And on the public side, I think what we're beginning to see here is a degree, there are signs of green shoots, if I put it like that, after a very tricky time for green economy stocks since the end of 2022. And we've actually just seen, and look, this is a short-term signal, but in the last month, the eco index of green economy stocks has actually outperformed the S&P 500 and also the NASDAQ. But hey, look, for our clients, corporate clients, this is, and for the bank, this is a big commercial opportunity. Jamie Dimon, our CEO, is being very clear publicly. We want to be the bank of choice for clients seeking energy transition-related advisory and financing. We actually, as a bank, made nearly $1 billion in revenue from green transactions and green clients last year. So this is very much an area of opportunity, not necessarily needing to be a problem.
When you look at some of the key takeaways on the big, beautiful bill, I mean, how difficult is it to, I guess, assess the impact on America's ability to participate in the green transition?
I think it's difficult at the moment because there's this big question about what elements in the IRA bill, the Inflation Reduction Act, what elements of that survive and what elements fall. But in some senses, I think the debate's moving from whether you're for or against investment in the energy transition or whether you believe that there is a climate crisis to where do you get your energy.
Right.
Energy abundance is something that, if you like, unites both sides of the debate. And we don't have enough of it. We have growing energy demand from electrification, AI. The higher temperatures lead to the consumption of more energy. And then, of course, what's happening in the emerging markets. 80% of the growth in energy demand last year came from emerging markets. And so where you can get enough energy to meet the demand is the big issue. And actually, secondly, I think we are seeing the interplay between geopolitics and this issue of energy becoming far more pronounced as we go into the second half of 2025.
So if you change the lens and look at it through a self-sufficiency energy lens, then I guess it changes the complex everything in terms of investment, in terms of capital raising and deployment of where the money goes to.
Completely. I mean, look, if you look at historically in the 18th and the 19th century, the UK used its prowess across coal partly to fuel its position as the leader in the first industrial revolution. In the 20th and going into the 21st century, obviously you saw the Middle East and its supply of oil being something that gave it a strategic edge. Going into this new and green industrial revolution, China is using its early investments in different green tech and infrastructure to give itself a real position. And nowhere is that more acute than when we look across critical minerals and rare earths, where China basically controls 70% of the production of critical minerals, 90% of the processing, and we have seen how they've used that and applied export restrictions in the context of the tariff tensions and the trade war that's ongoing at the moment. And to be frank, I don't think that this has been properly priced in by the market, the exposure of corporates to potential critical mineral supply chain issues, because the supply is quite concentrated in just a few countries, DRC, China, Indonesia, and so forth. And yet, a withdrawal of those critical minerals for many big Western companies across Europe and the US could potentially pose an existential threat. Now, we haven't seen that feed through into prices yet. People have been stockpiling these critical minerals.
At the margin, sometimes it has. Certain days, right, where there was more friction between, for example, China and the US.
But we're really seeing, and if you look at lithium, we have seen a 30% growth in lithium demand in 2024 relative to around 10% through the 2010s. So this is coming down the line, not being properly priced in, I think, by the market yet, but is going to become an increasing risk. And with the concentration of supply in just a few countries, the potential impact of a supply shock when something like that occurs will be quite great.
Turga, thank you so much for that. Turga Muna, there, Global Head of the Sustainable Solutions at JP Morgan. We also have the Sustainable Business Summit here at Bloomberg all day, so we'll be on stage very shortly. And you can follow all of that on Live Go on the Bloomberg terminal and on social media. Up next, Bloomberg Brief. Of course, I'll talk about Treasuries, dollar, and Jay Powell. This is Bloomberg.